Hello friends, welcome to Commerce Guide. This is Pranali. In today's video, we'll be discussing the basic journal entries. In our previous video, we had started with the journal entries. That was a part 1. This is a part 2. In that video, I have explained all the basics of journal entries, how to record the journal entries and all. Okay, so to watch that video, link has been given in the description box below. You can watch it. Okay, so let's begin with today's class. So before proceeding to the journal entries, let me tell you that to solve these journal entries, the rules of accounting are very much important. So in rules of accounting, there are three types: real account, personal account, and nominal account. Okay, so let me tell you the rules of this. The real account rule says that debit what comes into the business, credit what goes out of the business, and a personal account says that debit the receiver, credit the giver, and a nominal account says that debit all the expenses and losses, credit all the incomes and gains. Okay, so these were the rules of accounting. Now we'll start with the journal entries. Our first journal entry says that commission received in cash rupees 2000. Now see, every transaction is been recorded twice. Once it is debited, once it is credited. Fine. So here they're telling that commission is received in cash rupees 2000. Now what is commission here? Commission is an income. Okay, it is an item of income. So here first account which gets affected is what? Commission account. Okay, now we are receiving the commission in the form of cash. So second account which gets affected is what? Cash account. Now what a real account rule says that debit what comes into the business. Now what is coming into the business? Cash is coming in. So cash account debit to commission. Now what nominal account rule says that debit all the expenses and losses, credit all the incomes and gains. Now what is commission here? Commission is an income. So we are crediting the commission. So cash account debit to commission account rupees 3000. Now always remember that our debit and credit balance should be same. Okay, it will be always balanced. So 3000 debit, 3000 credit. Fine. So now let's go to the second entry. Goods given as charity of rupees 8000. Now what they're telling is that the goods are being given as charity. So the goods which are there in the company which they have purchased to sell it for future, okay, from that goods they are giving some amount of goods as charity. So charity is an expense here, okay, because goods are going out, so that is an expense in the form of charity. So first account affected is what? Charity account. Okay, and next account which gets affected is what? Goods or purchase account, because we are purchasing the goods to sell it further. From that only we are giving some amount of goods as charity. Okay, so now charity is an expense. Now what our nominal account rule says? Debit all the expenses and losses. So charity is an expense, so it will be debited to purchase account because goods are going out here of rupees 8000. Fine. So next entry is what? Carriage paid on machinery. So let me tell you what is carriage first. Okay, so see, carriage expenses are nothing but the transportation expenses. Okay, carriage expenses are nothing but the transportation expenses. Okay, for example, see, if you go to a shop, okay, if you go to a shop to purchase a refrigerator, okay, now I can't take that refrigerator home by my personal vehicle. No, I can't take it. So what I'll do is that I'll tell the shopkeeper to transport that refrigerator to my home. Okay, so what the shopkeeper does is that he'll transport that refrigerator by his by his vehicle to my home. So to transport that refrigerator, he'll charge me some amount. Okay, and that amount is known as what? Carriage expenses. Fine. So this was the example of a personal life. So let me give you an example of a business. So in business also same thing happens. Okay, suppose there is a manufacturer. Okay, a manufacturer sells the goods to the business. Okay, to the business. So now what a manufacturer does is that manufacturer sells the goods in bulk, that is in large quantity. Okay, so what he will do is that he'll transport that goods by his vehicle to the business. So he will charge some amount for that. That is known as what? Carriage expenses or transportation expenses. Fine. So let's go to the entry now. Carriage paid on machinery. Now they have purchased the machinery. On that machinery, they have paid some carriage. So that is what? It is an expense to the company, right? It is an expense to the company. Now they are charging the carriage on the machinery. So first account which gets affected is what? Machinery account. Okay, and they're paying this carriage in the form of cash, so cash accounts get affected here. Okay, so machinery account debit to cash account because cash is going out, and this is an expense, so it is being debited for rupees 1000. Fine, clear. So next we'll go to fourth entry, that is goods purchased from Ram. Goods purchased from Ram rupees 10,000. Now who is Ram here? Ram is a person, so personal account get affected here. Okay, so now two entries which gets affected are goods purchased. So first is what? Purchase account. We are purchasing it from Ram, so Ram account. Okay, now see we are purchasing the goods, so purchase account debit from Ram. Now Ram is the giver of the goods here. What a personal account rule says that debit the receiver, credit the giver. Now Ram is the giver, so we are crediting Ram account. Purchase account debit to Ram account rupees 10,000. Fine. So next is what? Goods returned to Ram. Now we are returning the goods to Ram. Okay, now when the word to comes, see here. If there is a company here, now goods are returned to Ram. We are returning the goods to Ram. We are returning it. Now, when we are returning it, we have purchased it before. Okay. Now, when we purchased it before, now we are returning it. Okay, because some goods are maybe they are been damaged or something, so we are returning it back. So, what gets affected here? Purchase return account get affected here. So, first entry is what? Purchase return account. Okay. Now, to whom we are returning it? We are returning it to Ram. So, second account is what? Ram's account. Now, Ram is the receiver of the goods. We are returning it to him. So, debit the receiver. So, Ram account will be debited to purchase return account rupees 4,000. Fine. Now, see, when we purchase the goods in previous entry, we have debited it. Now, to cancel that, because we are returning it back, so what will be here? Purchase return account will be credited here. Here purchase account is debited, purchase return account will be credited. Fine. So our next entry is what? Sold goods to Yukta. Okay, we are selling goods to Yukta. So here two accounts which gets affected are first is what? Sales account because we are selling the goods. To whom we are selling? To Yukta. So Yukta's account. Fine. Now we are selling the goods to Yukta. So Yukta is the receiver of the goods. So Yukta's account debit to sales account because say, goods are going out of the business of rupees 20,000. Fine. So next we'll go to the seventh entry, that is goods returned by Yukta. Now what they're saying is by Yukta. Okay. Now see here there is a company. Okay. Now goods returned by Yukta they are saying. So Yukta is a person here. She is returning it back to the company. Now, when she is returning it back, means company has sold the goods to Yukta first. So sales account. Okay, goods have been sold by the company to Yukta, and now she's returning it back. So what gets affected here? Sales return account. So first entry account will be what? Sales return account. Okay. Now by Yukta, goods are returned by Yukta. So second account which gets affected is what? Yukta's account. Okay. So sales return account will be debited to Yukta's account. Okay. Because Yukta is returning the goods. She is the giver of the goods. Okay. So sales return account debit to Yukta's account. Now in a previous entry, when we are selling the goods to Yukta, sales account was credited. But When we are returning it back, it will be on the opposite side, that is sales return account debit. Fine. So that was the difference between the two entries. Next is what? Loan taken rupees 1 lakh. Okay, now we are taking the loan of rupees 1 lakh. Okay, so now first account which gets affected is what? Cash account, because we are taking loan in the form of cash. So cash account. Okay, now we are taking the loan. So who is giving the loan here? Lender is giving the loan. So lender's loan account gets affected here. Okay, so now cash is coming in, cash account debit to lender's loan account. Okay, because lender is the giver here of rupees 1 lakh. Fine. So next entry is what? Interest paid on loan rupees 1000. Now what is interest paid on loan? The loan which we have taken, we are paying interest on that. Okay, we are paying interest means what? It is an expense to the company. Cash is going out. Okay, so cash is going out. So which account gets affected here? Cash account. And next account is what? Interest on loan. That is, it is an expense. So what a nominal account rule says that debit all the expenses and losses. So interest on loan account will be debited to cash account because we're paying the interest in the form of cash. So interest on loan account debit to cash account rupees 1000. Okay, so these were the journal entries. Okay, so hope you have cleared all this. Okay, so that's it for today's video. Hope you liked this video. Thank you.